Welcome to the Big Picture Retirement Show, where you'll learn what it really takes to have a successful retirement. With over 20 years of experience, your host, Rick Rivera of Safeguard Investment Advisory Group, has seen it all and is here to help you achieve your retirement dreams. This is the Big Picture Retirement Show.
Welcome into the Big Picture Retirement Show with Rick Rivera. I'm Mark Elliott. Rick is a partner at Safeguard Investment Advisory Group, along with Eddie Soda. You've heard Eddie on the program. Reed Abedin. Reed's going to be on the program as well coming up. But the guys at Safeguard have been doing this for over 20 years. They're here to help you figure out where you are on that road to retirement, help you plan for that. The Big Picture Blueprint really is about 5 pillars: income, investment, taxes, healthcare, legacy planning. What about Social Security? It's in the income part. What about Medicare? It's in the healthcare part. So a lot on your plate as a retiree, and it'd be kind of nice to have really your chief financial officer to help guide you, like the big Fortune 500 companies have. That's kind of what Reed and Eddie and Rick and the team do for you, is help you figure out what you should be doing for your specific situation, because everybody's situation is unique. If you'd like to talk with Rick about any of this or all of this, 800-700-1980, 800-700-1980. Of course, the website to learn more, safeguardinvestment.com. Rick, you ready to go today?
Yeah, let's do it. What do you got in store, Mark?
All right, here we go. We're going to kick this off with the President Donald J. Trump. And this was a few weeks ago talking to the houses of Congress. So here's what Trump had to say.
Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that. It won't be much.
So is that where we are with them? Because the markets have been pretty volatile lately. Are we in that little disturbance time period?
Yeah, I think so. Past couple of weeks, the market was, as you're saying, a little bit volatile. And here's the thing with the markets, and throughout history, it's been the same thing over and over again. Bottom line, the markets don't like uncertainty. That's what causes the volatility. And right now with the tariffs going on, I understand the premise behind it, totally get the premise behind it. The markets are going to be volatile. And, the big question here is, hey, during these volatile times, and throughout the years, we're going to have more volatile times. There'll be other things. If it's not tariffs, there's going to be something else. Hey, what are we doing to leverage these things in our favor? And that's the big thing.
And really, you think about it, every administration has their own game plan of things that they want to try to accomplish. And we know Trump is a little bit more in your face, a little bit more decisive. Sometimes it's good, sometimes it's not. But we don't really know. We just know that things are going to happen. I think when you think about the markets going all the way into February, markets really done really well. And I think they're down 10% or so since that time period. But it's not unusual. I mean, every year you've got 5% or less pullbacks, and you've got those are really 9% or less. Then you have the corrections every couple years, 10% or more. Every 3 to 5 years, you have a crash, basically, over 20%. So market fluctuation is not unusual. And I would think when you're putting the big picture blueprint together for people, especially that second pillar, the investment pillar, it is a lot about safety, but growth is important as well. But you got to kind of balance those two, I would imagine.
You have to balance the two, as you're saying. The scenario here, and to kind of pick up where you were saying, about as far as the volatility over the years, we know we're going to get it. And Mark, I can tell you this: if you even go back to Black Friday of 1987, history repeats itself. Where every
was that a Black Friday or a Black Monday?
Was it? Oh, did I say Black Friday?
Yeah.
Well. Yeah,
I think it was a Black Monday.
It was a black day in '87, and I appreciate you correcting me. But it was a black day in '87. Market drops. I think it was 6 months, a year later. People are like, "Dang it! If I only knew, I would have bought more." You think back in '99. Oh, if I only knew, I would have bought more. 2001, 2 planes crashed into a World Trade Center. Oh, if a year later, year and a half later, people are like, "Oh, if I only knew, I bought more." 2008, same thing. 2018, same thing. In March of 2020, the market drops 30% in 1 month, and again, a short time later, hey, if I only knew, I would have bought more. So the scenario here is our markets always recover. And we've seen all different types of, administrations, all different, we've seen inflation, we've seen oil embargoes, we've seen war, we've seen famine, we've seen all these different things. We know they're going to recover. So to pick up where you left off, when somebody is going to need income in retirement, it's how the investments are structured that allows them not to panic under those situations. Because the scenario is if the market is going down, we don't want to be drawing off those investments while they're going down and intensifying the losses even further. So if somebody needs, let's just say 5% to live on and the market's down 10, well, now, you're down 15, you're intensifying those losses. So it's how the investment portfolio is structured to create the income in such a way that regardless under any market condition, your income is safe. And if you know that your income is secure, then the money that is in the market, when the markets go down, now we're in a situation where we can say, hey, listen, for this bucket of money, we don't need that money to live on. We can let this do what it's supposed to do. We can now leverage the down markets in our favor because we don't have to sell anything in order to create our income and create even more losses. Now we can actually maybe buy more shares at cheaper prices. We can reinvest the dividends, make sure we're buying more shares at cheaper prices. And then if it makes sense for us to do Roth conversions, this is the best time for us to do Roth conversions. And there's other strategies that we use to leverage in clients' favor over the long haul. And again, it's having that diversified approach and a game plan. And one of the biggest things that I talk about, and I talk about it in the workshop, there's a big difference between an accumulation plan versus an income plan. That game completely changes once you get into retirement.
Yeah, which makes perfect sense. And if you'd like to learn more, how does this really affect you? The markets get bumpy. What should you be doing? Because everybody's situation is unique, and that's how Rick and the team at Safeguard look at it. It's 800-700-1980 if you'd like to have a conversation with them. There's no cost for this. 15-minute phone call just to see what's going on. You come into the office, for 45 minutes to an hour and sit down with Rick and really get into it. And when you do that, Rick always says, I've got 2 ideas that will enhance whatever it is you are currently doing. If you just come in and sit down with us, no cost. That's a great opportunity. Why not get some clarity into your retirement picture? 800-700-1980. That's 800-700-1980. Here's a stat for you, Rick, that I know you know. And this is if you put $10,000 in the S&P 500 from January 1 of 1980 to December 31st of 2022, so basically 42 years, that $10,000 in the S&P 500 you never touch, you just let it ride. Well, by the end of 2022, you had $1.1 million now in your portfolio. That's a pretty good deal for a $10,000 investment, but it's 42 years, but it just sat in the market and just let it go. Here's the crazy part of this. If you missed the best 5 index days in that 42-year period, that 1.1 million goes to like 671,000. If you missed the 10 best days in that 42-year period, you're now under $490,000. Like COVID you're talking about, the big uptick happened right after that March. I mean, it came back really fast. And if you missed it because you got scared, you just missed it. That's a pretty crazy number. You missed 5 days. You've now lost, over 450,000. You missed the best 10 days in a 40-plus year period. You've now lost almost 600,000. I mean, it's crazy to think of that.
Yeah, people want to time the market, and unfortunately, we can't do that. And we've talked to institutional money managers, over the years. And a common theme between, the institutional money managers that are not day trading, they stick to the fundamentals. They always say, you know what? It's not the timing of the market that allows you to get the best returns over the time. It's the time in the market that allows you to get the best returns over the longer period of time, which is exactly what you were stating. So the question is, okay, how can one do that? Well, it's fine. Like, again, when you're working and you're contributing to 401ks and all that, you don't need that money to live on. So you can let it do what it's supposed to do. You have a paycheck coming in. But once you retire, then again, that's where things need to be restructured, where we have a certain bucket that is specifically designed to create the income that you need. That way, a balance of the portfolio is designed for growth and what it's supposed to do. So the money and the investments should be designed with specific buckets or specific strategies for different things. Your market money was not designed to give you growth, keep up with inflation, give you income, be there for emergencies and things like that. Because let's face it, when I need my money the most, that's when the market's going to be down. So it's really creating a game plan while you're in retirement. Your income is secure and the investments can do what they're supposed to do, sort of like how when you were working. And the other big portion of this is communication with the clients, that they must understand the strategy. Because, we have friends that are brokers and they tell us, hey, when the market goes down, they're getting calls like crazy. We don't get that many calls. And I think the reason why we don't get that many calls is because the clients truly understand the plan. They truly understand the strategy. So when the market's going down, they're just not getting a call from us saying, hey, just hang in there. It'll come back again. Yeah, we know it's going to come back, but when? They understand, hey, wait a minute. They understand, oh, wait a minute, the market's down. Oh, Rick, this is a great time. This is the time that we need to start doing our Roth conversions. This is a time where we need to do this strategy or that strategy. So they understand we have a game plan. We actually leverage those down markets in their favor.
So really, it's about having the conversation with your clients at Safeguard Investment Advisory Group, Rick, where you talk to them about what they want out of their retirement, what are they planning to do, how they're going to spend their time, but what the purpose of their money is. Everybody has different purposes. Some want to leave it to their kids. Some want to, bounce the last check. So really, it's about having a strategy. And that's where sitting down with the team at Safeguard Investment Advisory Group is so important, because it is about you and your ability to have risk or not wanting risk. Some people are all in the market. Some people are not in the market at all. Most of us are a little bit of safety and growth at the same time. Rick and the team are here to help you figure out where you should be, where you're comfortable, and what you need. 800-700-1980 is the number. Again, no cost for this. 800-700-1980. I still think it might be one of the more important phone calls you make. Might be a second opinion, but for a lot of you, it might be a first opinion of where you are on that road to retirement. 800-700-1980. Back with more market volatility chatter right here on the Big Picture Retirement Show with Rick Rivera of Safeguard Investment Advisory Group.
You're listening to the Big Picture Retirement Show with Rick Rivera. For more information about Rick and the Safeguard Investment Advisory Group team, go to safeguardinvestment.com. While you're there, you can also download educational retirement guides and sign up for an upcoming seminar. That's safeguardinvestment.com. Now, back to the podcast.
Welcome back to the Big Picture Retirement Show with Rick Rivera of Safeguard Investment Advisory Group. I'm Mark Elliott. You can always find more about Rick and the team, safeguardinvestment.com, safeguardinvestment.com. Questions, market volatility is what we're talking about today on the program. If you have concerns and you're maybe a little nervous, or maybe you're like, hey, what a great buying opportunity, 800-700-1980 for Rick and the team to kind of help guide you along the way, 800-700-1980. I'm Mark Elliott. One of the challenges is we don't really know. If you go back to 07 to 09, right, the Great Recession, banking and housing financial crisis. Imagine in 07, we didn't know that it was going to basically end in March of 09. We didn't know the length of it. You go to COVID, I think people were surprised that was basically a month, 35% drop in a month or 6 weeks, I think it was. And then everything bounced back pretty quickly in the markets. We don't really know, what's short term, what's long term. And I guess you typically, if it's a function of what do they say? A function of the government or financial world, then it could be longer. But if it's an outside agency like COVID, it could be short term. How do you help people figure out short, long-term market, disturbances?
So that's actually a great question. What we do is basically when we put together plans, we're always planning for worst case scenario. That way we understand that, hey, listen, the worst case scenario happens, and let's say, COVID hits, something hits, and the market drops 30% tomorrow. Are we going to be okay? So how do we game plan for that? Well, we go back in history. We have to learn from history. And we know that historically, even back in 1929, when we had the Great Depression, market dropped roughly 80% in 1 year. We know literally people were jumping out of windows when that occurred. If those same people that were jumping out of those windows just waited 36 months, not only did the market rebound back, but also shot up 800% beyond that. Just 36 months. So we're talking, let's just say 3 years. And every recession, everything that occurred after that, all the volatility that happened in the market, all the recessions and things like that happened, lasted anywhere from, if you look back historically, anywhere from, I want to say 6 months to 3 years on the high side. And our markets, again, World War I, World War II, Vietnam, you name it, inflation, our markets have always recovered 100% of the time. So if I came to you, Mark, and I say, hey, listen, you know what? I got this market you can invest in that's recovered 95% of the time. You might say, hey, that's pretty good odds. Our market has recovered 100% of the time. So knowing that, and historically knowing this statistically, then what we do is we can create the investments where we say, hey, listen, how do we divide this portfolio up in such a way that we can create income for you on a guaranteed basis to last many years, 4, 5 years, 6 years, and allow the other investments to participate in the market. This way, if we do have down markets, we know we have this other bucket of money that we can go to that is completely safe, that you can get your income and rely on your income over many years without ever having to touch that bucket of money. So it's really when people start losing is when they have to draw into the investments while they're going down. But if I have a whole nother bucket of money that's available to me that I can draw off of it in order to allow the growth money to do what it's supposed to do, this is how we design the program. And then we have also other buckets for emergencies. So that way, if there is an emergency and you call me up and you're like, hey, Rick, I need 20 grand to fix the roof on the house. You're going to say, well, Rick, I don't want to pull it out of the market investments because, the markets are down right now and we're doing our Roth conversions and all these other strategies. And Rick, I really don't want to pull it out of my income bucket because if I pull it out of my income bucket, that's going to reduce my income. I don't want to do that. Well, guess what? We have funds set aside for emergencies. So really what we're doing is we're having different categories of money that are designed to offset, hedge each other. So we don't have to draw off of those investments at the most inappropriate time. So again, we're designing the plan, and I'm keeping it very simplistic for the radio show, but we're designing the plan that under the worst case scenario, no matter what happens, you're going to be fine. And if under that scenario, you're going to be fine, I don't need to worry about the best case scenario because I know if the market continues to run, I know you're going to be okay under that situation. And again, it's about being educated, understanding the plan, understanding the strategy, then going forward, you can sleep at night. And that's the big thing.
Yeah, so you think about it. When you're retired, your paychecks are no longer coming in. So your paychecks are coming from the stuff you've gotten. Social Security could be one of it. Could be a pension if you're lucky enough to have one. Could be out of your market monies. Could be, do you have an emergency fund? Do you need to build that up? Do you not know? Where are you? What are your options when it comes to your income in retirement? Is it all at risk? Is it all safe? Probably not. Probably a little bit of both, like Rick was just talking about. But at the end of the day, it's about how do we put things in place when the markets are great, we're good. Markets are bad, we're still okay. That's really the key. 800-700-1980 is a number to chat with Rick and the team at Safeguard Investment Advisor Group. Again, no cost for this, no obligation, no pressure, no judgment. 800-700-1980. I still think it's one of the more important phone calls you could make because we are talking about the next 20, 30 years of your life. Having a plan is that important. 800-700-1980. And you mentioned earlier that you haven't gotten a lot of calls. Markets got bumpy. How do you talk to your clients about market volatility that kind of eases their tension level when we do go through tougher times in the market?
By preemptively striking it. And that's where I was saying that's where the communication comes in, because what we do is during the good times, we tell them, hey, listen, here's the plan, here's the strategy. We know things are good right now, but inevitably, we know that the markets just don't keep going up in a straight line. So because if that was the case, then everybody would just put 100% of all their assets in the market and never put anything in savings accounts or checking accounts or CDs or there would be no need for any other type of investments because we know the market just keeps shooting up every day and they never go down. So if we already know in advance that, hey, we're going to have volatility and we're going to get hit by surprises in the market, maybe the Feds decide they're going to raise interest rates or lower interest rates or, again, whatever occurs, we need to plan for those scenarios ahead of time. And if we're communicating with our clients and telling them, hey, listen, when this occurs, which we know it's going to happen, here is what we're doing to leverage this in your favor. And here's the game plan. Now, quite frankly, when we do have volatility in the market, our clients realize, oh, wait a minute, they're not seeing the volatility as negative. They're actually seeing the volatility as an opportunity. They're like, oh, you know what? We know that let's take a 10-year run of the market, any 10-year period of time. We know that there's going to be at least 2 or 3 years in that 10-year period of time that the market will be down. And if we know that for a fact, well, then, hey, listen, what are we doing when it does happen to leverage those things in our favor? So this is a scenario where our clients are calling us up and saying, oh, Rick, now's a great time for us to do this particular strategy or this other strategy. Or maybe, hey, you know what? I got some extra money that came in. Now's the time for me to buy more shares at these cheaper prices. So because we've had the communication ahead of time, they understand the game plan ahead of time. When the market is volatile, Now it's not a scenario, again, where they're panicking and saying, oh my God, what do I do? They're like, oh, great. Now is just the time that we should be enacting these other strategies that we talked about so we can leverage this in our favor. So it's more of a looking at it as opportunity rather than a negative thing, or that they have to run for the hills, so to speak.
And I would imagine a part of the big picture blueprint when you're sitting down with somebody is a lot of people is while we're working, we're like, man, we need 10, 15, 20% return. It's about the return on the investment. When you get to retirement, isn't it more about the return of income, right? Income is the biggest hurdle for a lot of people in retirement.
It's huge. And even if, let's say, for example, somebody doesn't need income off of their investments. So you're 100% right. Absolutely, when they need income. But let's go with both scenarios. Let's say they need income, or maybe they don't need income off the investments. Once you've won that comfortable retirement, I want people to think about this. Once you've won that comfortable retirement, whether you need the income or you don't, the point that I want to make is that let's say the market shoots up 30% tomorrow. Oh, that'd be nice. It'd be great to see that on your statement. But is that going to change your lifestyle? Are you now going to go and buy a new Ferrari or buy a new home or a bigger mansion? Most of you maybe not. But what if the market shot down 30% tomorrow? Could that have an effect on your retirement planning? Or could that have an effect on your psyche alone, knowing that you lost that much money? So when you won the comfortable retirement, you don't participate that much on the upside, but it can affect you greatly on the downside. So don't misconstrue what I'm saying. I'm not saying you should run away from all risk, but what I'm saying is that we need to evaluate that risk, make sure that it's putting you in the right position at the right time. So if you want to know about those specific strategies that unfortunately on the radio show, it's hard to go into big detail and everybody's situation is different, give us a call right now, toll free 800-700-1980. And as I always say on the show, if you just give me 1 hour of your time, leave your checkbooks and all that behind, but just give me 1 hour of your time, I can promise you I'll give you at least 2 ideas that will enhance whatever it is that you're doing, and it'll cost you nothing to do.
800-700-1980 is the number to talk with Rick Rivera, the team at Safeguard Investment Advisor Group. 800-700-1980. Take advantage of this great opportunity for you and your family. 800-700-1980. Rick, as always, a pleasure. Enjoy the rest of the weekend. We'll do it again next week.
Great. Thank you so much, Mark.
Firm offers insurance services. Safeguard Investment Advisory Group, LLC is a registered investment advisory firm. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Safeguard Investment Advisory Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Safeguard Investment Advisory Group, LLC.